thank you guys for coming. I'm going to hand it over to Lee and James, who's our special guest, and I am going to kind of manage the chat. We'll probably get to all the questions at the end here. And then in the meantime, I'm going to plug in my computer, or none of that will happen.
Hey everybody. I'm gonna let James introduce himself, but we just kind of wanted to go over, some best practices as tax season comes up and answer as many questions as possible. James can kind of explain his relationship to small businesses and to artists, but yeah, just throw anything in the chat. And like Louise said, we'll have a Q&A at the end, so just wait till the end for your questions. But I'll give it over to James.
Wonderful. Thank you, Lee. Thank you, Louise, for having me. And thank you all for joining. I'm going to go ahead and kind of get things going here on the presentation. So as Lee and Louise said, my name is James Lee. I'm a CPA. I practice here in Denver, Colorado. And I have a pretty extensive background actually working with small businesses. My dad has been a small business owner for my entire life, or more or less for my entire life. I've been a small business owner myself now for going on about 9 years, and I work with close to probably at least 100, if maybe not up to 125 small businesses, from one owner person all the way up to one of my businesses I think has about 50 employees. So work with a wide range of size businesses, but also a wide range of industries, everybody from attorneys, financial advisors, artists, musicians, lawn care, landscaping, manufacturing, healthcare, pretty much anything and everything that you can imagine as being in an industry. I know it very well. And also I work with a lot of different states. So I started my tax business here or in Iowa, actually, and then have been in Denver now for about 4.5 years and have been practicing as a CPA here in Denver that entire time. So I do taxes in probably 20 different states for small businesses and individuals. So pretty wide range of experience and knowledge, and kind of dig into it here. One disclaimer I always kind of like to put out there is that when it comes to taxes, accounting, anything like that, it's different for everybody. Everybody's situation is different from another, and the advice that I can give for an individual in their business is going to depend on their situation. And so none of this presentation should be construed exactly as advice for what somebody should do, but it's just kind of general information, kind of a starting point for discussion. Here's the quick little bio about me that I put together. I've already pretty much told you everything. One thing is I'm a terrible artist. The extent of my artistic capability is music. I do play a couple of instruments, but my brother and sister were blessed with good artistic talent, which I'm always very jealous of. Other than that, I spend a lot of time outdoors when it's not tax season. I like to ski, which is not very good when you do taxes this time of year. But yeah, let's go ahead and dig in to the fun stuff. So probably the number one area that I get asked about the most from small business owners that are clients or prospective clients is how somebody's business should be set up and structured. And there really are 3 common ways to do that. There's a few more other options here, but these are by far and away probably 95% of the way that small businesses are set up is one of these 3. A sole proprietorship, which a lot of people aren't totally familiar with, but it pretty much just means it's just you, one person. There's an LLC, or a limited liability company, and then an S corporation. I'll get into a little bit more of the specifics on each one, but really kind of the very high level stuff is that an LLC and an S corporation provide what's called limited liability protection for their owners. And what that is protection from lawsuits, as far as if you or your business gets sued for something that you did as part of your business, it provides protection for your personal assets. And I'm not an attorney, but I deal a lot with that side of things on the tax side. And so just know that it's a protection for your personal side of things, not necessarily the business. Another thing is that LLCs and S corporations can have multiple owners, whereas a sole proprietorship really is just one owner. All of these three structures can have employees, they can have contractors, but depending on the structure, the owner may or may not be considered an employee as we traditionally think about them. And then the last is that one of the easiest ways to kind of think about the big difference between these three types of companies from a tax and a financial standpoint is that there is a very close relationship between the simplicity of the organization, the cost of compliance, which more or less kind of means like, filings with the state or tax return filing costs and everything like that, the taxation or the taxes that are paid by the owner and or the company, and then also liability, which kind of gets back to that limited liability thing earlier. So I'll dig into, and we'll start with sole proprietorships, or a sole prop as they're sometimes called for short. As I mentioned earlier, these are the simplest form of a small business structure. It is just a one person individual. There are no formal business filings with a given state, which is something that also is asked about a lot. Most businesses actually are organized at a state level. So my company is an LLC within the state of Colorado. I just had to file a form to do that. But a sole proprietor, you don't need to do that at all. You just go into business for yourself, which for an industry like art is quite common. Most sole proprietorships more or less just use the owner's name, so it could be James Lee Art, if I wanted to so call it, as long as that name is available. If I wanted to, I could go to the Secretary of State office for Colorado and get what's called a doing business as, or a trade name, or a DBA, where then I could come up with a true kind of brand name, like my company is JBL & Co. CPAs LLC. That's my doing business as or brand name. That has to be done at the state level, and you have to file a form to do that. Then the owner of a sole proprietorship. So if I was a sole proprietorship and I'm just the one owner, I am actually not considered an employee of my company as far as taxes are concerned. And there's some implications for that we'll get into in just a few minutes, but that's a big one that a lot of times I have to correct a lot of people on when it comes to their accounting or the terms that they'll use to talk about things. As I mentioned earlier, sole proprietorships provide no limited liability protection, which means maybe a good example is if people are familiar with the blue horse that is out by DIA. It's pretty well known that during the fabrication or construction of that horse, it fell and killed the artist who was building it. To kind of modify that example a little bit, say that had not happened, but the artist was maybe transporting it, or somebody was coming into the artist's workshop to take a look at the sculpture there, and it fell on somebody else and killed them. That would be an example of a time when there very much could be a liability issue there, where the artist could be sued, or their business could be sued by the family of the person who was killed. If the artist was a sole proprietorship, that means at that point that if a court would decide that the artist was at fault and that person should not have died, the artist should have taken better care, the artist's business, as well as all of their personal assets, could be subject to a judgment from that lawsuit, which means they could almost lose everything in theory. And so that's one of the big risks of the sole proprietorship. If you're doing painting, probably not a very big risk. But if you do something bigger, heavier, if you're traveling for work, those types of considerations quickly make a difference when determining if you need limited liability protection or not. And then last, the sole proprietorship being the most simple form also means it has the lowest cost. There's really no cost to get started. However, it has the highest taxation and also the highest risk of liability. So from there, we'll move on to LLCs. So an LLC is an intermediate form of business structure, which means that there is a formal business filing that is done with the state or states where the business is going to operate. Usually a business will want to do a filing with the IRS as well to obtain what's called an employer identification number. That's kind of like a social security number, but for the business. Most LLCs, when they set up, use a legal business name. However, some do use just kind of like the owner's name. And also a lot of them do also set up with a doing business as or kind of a brand name or a trade name. A traditional LLC usually only has one owner, which means it's a single member LLC. But there can also be LLCs out there that have two or more owners, which automatically becomes, at least in the tax world, a partnership. I'm not going to get into the details of a partnership because it gets complex quickly, and I don't have any artists that belong to a partnership as far as business. Well, take that back. I do have a husband and a wife that are in a business partnership in art, but that's a special circumstance maybe. So similar to a sole proprietorship, single and multi-member LLC owners are not considered employees of their business. And again, in a minute here, I'll get to why that kind of matters. The biggest benefit and kind of step up from a sole proprietorship to an LLC is that there is limited liability protection provided by the LLC. To go back to my earlier example, if same thing, somebody comes to visit the workshop where that horse is being fabricated, falls on him and kills him, the artist has an LLC in place, and that's how all the business is done. Everything's filed and organized properly. At that point, the deceased's family members could still sue the artist business. However, unless the artist committed fraud or what's called gross negligence, the only thing that the court could award in judgment is the assets of the business. So in this case, the artist could not lose their personal home, their personal vehicle, their personal bank accounts. If they owned their workshop building, they could lose their workshop building, they could lose their bank accounts, they could lose all the other art that's in there to be sold off to pay for the judgment. However, all of their personal assets would be protected from that lawsuit. So that's really a good example, I think, of where an LLC can be valuable. And the fact that it's actually a pretty low cost and easy thing to get set up. It's kind of one of those where why not just do it just to be safe? Similar to a sole proprietorship, an LLC is a very simple setup. It's very low cost. However, it still does have a high taxation. But the benefit there is that there is the lower liability risk that gets traded for the cost and need to file business documents with the state and usually the IRS. So from LLC, we'll move on to S corporation. And this is one that a lot of people are kind of familiar with the idea of a corporation, but an S corporation is a very specific type. There is another type of corporation that I'm not going to get into because it pretty much never gets used, especially for artists. But an S corporation is really the most complex form of most small business structures. There are formal business filings with state or states, as well as the IRS. The vast majority of S corporations also use a legal business name, have a doing business as. And they have one owner, but they can have up to 100 different owners. And owners are usually also called shareholders for S corporations, but not going to get into semantics with that too much. But an S corporation is the first example where an owner or owners are considered employees of their own business. So for an LLC and sole proprietorship, they are not considered employees, but for an S corporation, they are. An S corporation provides more or less the same amount of limited liability protection as an LLC, probably even a little bit more, depending on most circumstances. However, the fact that it's the most complex, or one of the most complex setups, also means that there's a much higher cost as far as the filings. You have to have much more detailed bookkeeping. There's a whole additional cost when it comes to the tax returns. However, in reward for those costs and the extra work that it takes to get these things set up and run every year, there is a pretty good amount of tax saving that comes out of an S corporation, and again, lower liability risk. So from here, I'm going to kind of transition a little bit more and talk a little bit about basics of accounting for small businesses, but also how that relates to taxes, and then I'll tie it back in just a tiny bit more to each of the three business structures. So one of the other kind of common areas where, being an accountant, of course, I kind of have, I have the ideal words or terms that are used for things that I, spent all that time in school learning about. And most people know a lot of the words, I've heard them, but sometimes there can be some confusion. Probably the most confusion when it comes to accounting and bookkeeping with my clients is with expenses, when revenue or income should be recognized, what they owe taxes on, things like that. So that's kind of the idea behind this slide here, and then we'll get into more specifics later. But the number one thing is that at the end of the day, everybody knows you want to make profit from your business, and profit is revenue minus expenses. Revenue can also be called income, and that really, for the most part, is defined as cash that is brought into your business during a given calendar year. That is revenue. However, it can also be things like in kind, which is something that probably more than any other industry my artists probably deal with the most, is in kind, which we can also refer to as trade or bartering. I actually just the other day actually entered into a kind of a bartered deal with one of my artist clients. He's a guitar teacher, and I am going to start doing his business's bookkeeping and accounting in exchange for guitar lessons, because I played guitar for a long time but never actually been taught by a true guitar teacher. And so in exchange for me not having to pay for guitar lessons, he won't have to pay me for his bookkeeping services for his business. That actually truly is kind of still revenue for me and revenue for his business as well. The trick there is the value that you would attach to that. So I'm not going to get into that because it's kind of complicated, but technically that is also revenue. Expenses are probably a little bit easier for people to understand. That's just when you go out and you buy something, pay cash for something, charge it to a credit card, debit card, check. If you take out a loan and buy a big piece of equipment, those are going to be expenses, and those are a deduction against your revenue, your business's revenue, to arrive at profit. Similar, you can also have expenses that arise out of trade and barter, not probably as common as on the revenue side, but it can happen. And then at the end of the day, revenue minus expenses gets you to your net income or profit, as it usually is referred to. And all that basically means is it's an approximation for if you brought in $50,000 in cash during the year, you spent $10,000 on expenses, your net profit is $40,000. When adjusting for the fact that you're going to have to pay yourself and everything throughout the year, you should have more or less a net of $40,000 that you made or earned for the year that can be represented in cash. It is also the most common way to determine what small business owners are going to owe for taxes is an assessment against their profit. So as I kind of mentioned there, one of the big things or areas I get asked about a lot is how a business owner is even going to pay themselves. So this kind of does get back to what I talked about a few minutes ago with the different business structures between sole proprietorship, LLC, and an S corporation. Is there's a pretty big divide between the LLC, sole proprietorship, and S corp in, as I had mentioned, employee status for the owner. Sole proprietorships and a single member LLC, they are not considered employees, so they cannot have a salary that they pay to themselves, where I'm speaking in the traditional sense of people that, you know, grew up and worked at McDonald's as a job and got paid a W-2 wages. You know, they probably an hourly wage, minimum wage, or whatever. You would work throughout the year, they'd pay you a set amount for however many hours you worked, and then in January of that next year, you would get a W-2 in the mail for you to do your taxes. As a sole proprietor or a single member LLC, you cannot do that. It is what we call a draw or a distribution. Those are just kind of interchangeable terms. That is money that is just strictly taken out of a bank account. So if you have a business bank account and you need some money as the owner, you just go to the bank account and you take some money out, whether you electronically transfer it to a personal bank account, write yourself a check, and then you go and deposit it into your personal check bank account. Doesn't matter. It's one and the same. One of the benefits is you can do that anytime and in any amount that you would like. So you can take 3 distributions in 1 month and none the next. You can take $5,000 in one distribution and $500 in the next. However, the biggest thing, and this is probably the number one area I correct the most for my small business owners, is that draws or distributions are not a deductible expense as far as accounting and tax are concerned. The salary equivalent for an owner of a sole proprietorship or a single member LLC, as I mentioned before, is the profit. So the $40,000 from the example that I used earlier, that is more or less the equivalent of your salary, and that is what you will be taxed on. The next thing down is for multi-member LLCs or partnerships. They have what is called a guaranteed payment, which is kind of a blend between a draw and a salary, but they can also do draws or distributions. So they can do both. They can do one or the other. You know, it doesn't matter which one. They can do whichever one they would choose. And again, draws or distributions, you can choose to do in 1 month and not the next. But a guaranteed payment is something, like I said, it's kind of a little bit more like a salary. It is something that is taken at a specified time and a specified amount, and it is agreed upon ahead of time by the different partners or members that are owners of a company. And it is paid directly out of a business bank account, usually in the form of a check or a draw. And it is a deductible business expense for accounting and tax purposes at the company level. It is taxed the same way as profit to a small business owner that's an LLC or a sole proprietorship, but the business does get to take a deduction for the total amount of guaranteed payments for a year, which is kind of a nice deal. Last but not least, an S corporation, as I mentioned before, the employee or the owner is considered an employee as long as they're actively participating in the business, and they can pay themselves a salary. They can pay themselves however often they would like. Usually it needs to be set and agreed upon and not changed. So it could be every 2 weeks, which is bi-weekly, or every month. I have some clients of mine that cash flow is unpredictable, like real estate agents. You know, they sell a lot of homes in the summer, but in the winter, nobody wants to move. And so they don't have a whole lot of money coming in the winter. A lot of times they'll pay themselves just once a year in a very specific way that I'm not going to get into. But that is something I meet with them and we determine and go through all the paperwork and stuff. But that one is very much as most people would be familiar with, that you pay yourself, you get a W-2. In January of the next year, you have tax withholdings that come out of it for federal and state taxes. You have to pay Social Security and Medicare taxes out of your salary, and your company has to pay those as well, which is something that a lot of business owners don't know. But similar to a guaranteed payment, the salary and taxes that are paid on top of salaries, that is a deductible business expense for accounting and tax purposes. So I've kind of made a couple of allusions to the fact that the different forms of businesses are taxed in different ways. And now that we've kind of talked about how owners can pay themselves, we're going to talk about how taxes are going to be assessed and paid as well. Probably one of the next most common areas that I educate clients on is that pretty much no small business actually pays taxes itself. Almost all small businesses, the taxes are paid by the owner of the business. And so that's something that comes as a surprise to a lot of new business owners. And for a sole proprietorship or a single member LLC, that is very much the case. The taxes are actually filed on just more or less a 2-page insertion into the owner's individual tax return. So the Form 1040 or individual tax return that pretty much everybody needs to file each year, there is a small business return that just gets put in there, and you've kind of like I went over earlier, you start with your revenue, enter all your different areas of expenses, get to your net profit. And from there, that net profit flows, as we say, from this small business return, which is called a Schedule C, or commercial, maybe is an easy way to think about it, flows over to your Form 1040, where then the taxes are determined. As I alluded to earlier, a sole proprietorship and a single member LLC have the highest amount of tax that is owed on the net income or profit. And that is because more or less all profit is assessed self-employment tax, which is 15.3%. So if you have $100,000 of profit in your business for the year, your self-employment tax is going to be $15,300. That is before we even get to income taxes, which income taxes is what most people are familiar with. It's the self-employment that people wonder, what is that? Why I haven't had to pay self-employment before when I was just an employee. And that's because self-employment taxes are actually the Medicare and Social Security taxes that all employees have to have withheld from their wages. Self-employment taxes are just the same thing. It's how self-employed business owners still get Social Security benefits when they retire, and how they pay into the Medicare system. And the downside, though, that a lot of people don't know is that that 15.3% is actually because when you're an employee of a business somewhere, you only have to pay 7.65% on your wages. Your business or your employer, the company, also has to pay that same 7.65% on top of what they're paying you for your salary. So you put the two 7.65% together, it's 15.3. As a small business owner, you are considered both employee and technically, or you are considered employer, but also technically employee. So that's why you have to pay both sides. And so that's really the pinch, because same example, if you've got $100,000 of profit for your business, 15,300 is owed for self-employment tax. Depending on other parts of your personal situation, you might owe another $10,000 or $15,000 in income tax on that $100,000 in profit. That means for the year, you might owe $25,000 or more in income and self-employment taxes on your $100,000 small business profit. So a lot of times you'll hear small business owners complain that taxes are really high for small business owners, or that they pay half of their income in taxes. This is where that can happen. If all of a sudden your small business makes $300,000 in a year, self-employment tax plus income tax could easily approach 40% or more. The next one down, multi-member LLC or a partnership files a separate tax return of its own called the Form 1065. It provides a special form that then goes over to the different owners or members' personal tax returns. I'm not going to get into the details there. One thing I skipped on the previous one, sole prop and single member LLC, because it's part of your individual tax return, it's not due to be filed until April 15th, roughly every year, unless you do an extension. But without getting into the details, that does not mean you have an extension on the time to pay your taxes. Very common thing there. So even if you extend in April and you don't pay until October, you're going to owe some money and interest and penalties if you didn't pay tax ahead of time in April. Pivot back for the multi-member LLC or partnership. Those tax returns for the business is due March 15th. So that's another common area. I'll get a new business client and they'll come to me at the end of March, like, hey, I need to file my business's tax return. I'm like, you're already late. Unfortunately, you already owe a penalty. It's due March 15th. Those can be extended as well into September, but not going to get into that. The owners of a multi-member LLC or partnership owe, unfortunately, the same amount of self-employment tax on their share of their company's profit, just like a sole proprietorship or a single member LLC does. And then they also owe income taxes as well. So there really isn't much source of income tax savings when it comes to a multi-member LLC or a partnership. Really, the biggest thing is just that at that point you have multiple owners of a business. You can, spread out the workload or whatever. But tax-wise, really not much in the form of savings, at least as far as small businesses are concerned. And then last but not least, the S corporation. Kind of like the multi-member LLC partnership, it files its own separate tax return as part of the business, totally separate from the individual's return. Provides the same form to the owner or the owners. It's also due March 15th, unless it gets extended. However, the big benefit to an S corporation is that, as I mentioned earlier, the owner or owners of an S corporation are usually considered employees of the company and pay themselves a salary and has tax withholdings, and they pay the same Social Security and Medicare taxes on their salary as an employee in any other business would. And the company has to pay that same match on Social Security and Medicare taxes. However, the big benefit is that because they are paying themselves a salary, they do not owe self-employment tax on the company's net income. So that is where the big source of tax savings comes from. So to use my earlier example, same one, $100,000 of small business profit. Let's say that the owner pays themselves a $40,000 salary. that means that now that business actually has a profit of $60,000 because that $40,000 is considered an expense. That $60,000 that gets left over is only going to be subject to income tax on that owner's individual tax return. So no more 15.3% tax charged on that $60,000. It's just going to be income tax. So the income tax is still going to be roughly the same $10,000 to $15,000 as it was before. However, no more $15,300 of self-employment tax. Self-employment tax, or its equivalent in this example, would be 15.3% on the 40% or on the $40,000 salary for the owner. So that's roughly $6,000 in tax versus $15,300. So that right there probably is the best example of where an S corporation saves money, is that in this example, it's saving about $7,000 in self-employment taxes. Some of that is picked up in other areas. Like I said, it is much more costly to have an S corporation than a single member LLC. And so you do kind of give back some of that in additional expenses, but on the whole, if it makes sense to be an S corporation, you're going to save some tax money. So really that is kind of the very basics that I give to a lot of my small business owners as they're getting started up, or if they're wondering if they should switch from one business structure to another. So what I went ahead and did is I thought about a lot of the questions or concerns that I get from artists and other small business owners throughout a given year, and put them kind of together. Maybe for some of you, this might answer questions that you have. It might make you think of other ones. Especially on the last subject here, it might make some of the existing or experienced artists kind of wonder if they've done things right or wrong in the past. And I don't want anybody to fret too much, but it's good discussion points, things to think about. So I'll kind of dive into some of those here. One of the areas that I'll talk about is grants, which is a pretty common source of revenue for artists, especially physical artists, as far as sculpture and painting and other stuff like that. Those will sometimes a museum or a business will pay somebody a grant or award them something to do a project for them. Another area is 1099s, Form 1099s. I get asked about those every single year from all my different business owners. Do I need one? Do I need to file them? I received it from this person I did some work for. Do you need it? Those types of questions. And then last but not least, the big painful one that really is becoming a much bigger issue is sales tax, which unfortunately for a lot of my artists, it's become a much bigger issue the last couple of years as states and business owners become more aware of the need to probably collect and pay sales tax. So I'll dive into each of these areas a little bit more and answer each one of these questions, but kind of wanted to throw these out there so it could hopefully spur some thought or answer maybe some questions that you guys might have. So the first one is grants, which at least as far as I'm concerned, the traditional definition of grant is, cash that gets paid out to somebody in exchange for work or something that is going to be ongoing usually. So, you could be awarded a grant in November of a given year, but not start working on it until December or January. But as long as you were paid that grant in cash in a given calendar year, it's income for that year. That is one of the biggest things. Another big areas that my business owners get confused about is like, well, I was paid the grant in November, but I didn't start working on it until January. I shouldn't have to claim that income until January. That's not, unfortunately, correct. One of the times that is kind of correct is that you could be awarded, say, like a $30,000 grant in November, but it's going to be paid out in equal installments over 3 years. in that situation, you would only pick up the $10,000 that you would be paid each year as income. Kind of that ties in a little bit to expenses as well. Yeah, if you got your grant in November, but you didn't actually start buying your supplies or whatever until January, you have to pick the income up for that previous year, and you don't get to claim the expenses until that whole next year of tax filing for that January year. So that's one area that it can kind of stink. One area I've run into here and there, but not real common, is if a grant has to be repaid either in full or partially. So same example, if you get a $30,000 grant in November of a year, but then that December, the institution or whatever that gave you the grant says, oh, actually, no, we need to change things. We need $10,000 of that back. You know, we're changing the scope of the project or whatever it is. If you have to repay $10,000 in that same year that you received the cash, more or less, you're only going to end up owing tax on the $20,000 that you did get to keep. Same thing if you paid it in full, had to repay it in full, you wouldn't pay tax on anything because you never got really any benefit out of it. However, if you got paid $30,000 in November, say you started working on it that next January, and then they come back and they say, oh, no, actually, yeah, we changed our mind, or we're going to change the scope. We need $10,000 of that back. Unfortunately, you have to claim all $30,000 as income for that tax year of that November, because you did have $30,000 that whole year available to you. And the $10,000 that you repay in that next January is going to be an expense for the year of that January, which that's really the part that stinks, because that's not a great solution for a lot of people, and it can pinch people cash wise, but that's unfortunately how things would be treated. One area I get asked is, hey, like, I got a $30,000 grant, but it's, they're giving me $30,000, but I have to go out and I have to buy all of my own supplies. I have to pay my own expenses and everything like that. That is pretty common. And those supplies and everything like that, those are expenses that you deduct against the income that you received from that grant, which means that at the end of the day, you won't pay tax on the full $30,000, assuming that you bought paid all of your expenses or bought all of your materials in the same year that you received the grant. One of the few times this can be different is, say you get a $30,000 grant in November, you go out and buy some materials and other stuff like that same year, but then you finish up in January of that next year, and the business or institution comes to you and says, hey, actually, you can, let us know you paid $5,000 for expenses. We'll give you another $5,000. That's called a reimbursement. That you would still get to take those expenses against the $30,000 in that previous year. However, that next year, you have to pick up that $5,000 that you received in reimbursement as income. So that's something that kind of stinks as well. A lot of clients don't expect that. Last is I've had maybe one or two situations, and I did read online that this happens sometimes. If you receive a grant or some other form of income from a benefactor or a patron or something like that, and they say, I don't want anything in return. You don't need to give me any physical goods, no art, no music, no services. That is pretty much the definition of winning the lottery. It's free money. That is, in the tax world, what we call a gift. And the vast majority of the time, that's actually not taxable to the recipient. So if somebody comes to you and says, hey, just showing some artist appreciation, here's $50,000, I don't want anything in return, that's tax-free to you, and that's the best kind of money to get. The tax implication actually in that case goes on to the giver or the gifter in that circumstance, but for the recipient, nothing you need to worry about. But again, like I kind of mentioned earlier, it's one of those, I always say it depends. Depends on the situation. If there is something like down the line, they say, but in a year or two, I'm going to want something from you, then unfortunately that is probably going to be considered income. So just kind of depends on the situation. Next area that, you know, last month and this month, I get asked about all the time, 1099s. I've got a small little snippet of one down the bottom right corner of what's called a 1099 NEC, non-employee compensation, which is a new form that started in 2020, I believe. It used to be 1099-MISC, and then there were various areas on that form where you would designate what type of income or expense was paid to somebody. But now there is one specifically for non-employee compensation, which is traditionally what we call a contractor, which means you went and did work for somebody, for an individual, their business or something, but you are not an ongoing employee of that business. If they paid you more than $600 in a given calendar year, they should be providing you with a Form 1099 NEC. What that does is it's basically a way of doing bookkeeping and record keeping for businesses that proves or reports to the IRS that they did pay you or your business for these services or goods. But actually the number one reason for these forms being required for filing is that the IRS keeps them not so much for the businesses to claim as an expense, but so that you as the recipient have to claim that as income. So if you went and worked as an art contractor in somebody's studio got paid $1,000, they send you a 1099, and you do not file a small business tax return to claim that $1,000 of income, the IRS knows that you need to claim that $1,000, and they're going to send you a nasty little letter that says you owe us income tax on that $1,000, and you owe us self-employment tax, and now you owe us interest and penalty because you didn't report it on your tax return and pay the taxes owed. So more than anything, a 1099 is kind of an informational thing for the IRS. It is something that they do say, you know, it's a required form that needs to be filed, but it's pretty lax as far as if you're late filing it, the IRS doesn't penalize you. I've never heard of that happening. So I file 1099s in March and April every year, and there's nothing big that comes out of it. If you don't receive a 1099 from somebody, it's not a big deal as long as you claim the income that you earn from that business or individual. Like I said, the threshold is $600 or more in a given year, calendar year, for goods and or services. The goods is something where that one's a little bit more, probably not quite as common that people send out a 1099 for goods, but it can happen. Services is much more of the common thing. So again, you go and work for somebody in their workshop or something. For the most part, you are providing a service to them, and so that's where 1099s come most in handy is with services. A lot of times clients like, hey, I need to file a 1099 for my contractor. And I say, okay, perfect. Send me their Form W-9. And they look at me with wide eyes and like, what's a Form W-9? A Form W-9 is an informational form that you can download online directly from the IRS that a contractor can fill out with their individual information or their business's information, social security number, employer identification number, mailing address. They have to sign and date it. And basically what that information is needed for is because that's the information that somebody like me would need in order to fill out and file a Form 1099 to send to the IRS and then provide to that contractor. So if you're going to work for somebody in their workshop or something and they ask you to fill out a Form W-9, good chance they're doing that because they're anticipating having to send you a 1099 after the end of the year. If you are going to be the person employing a contractor in your workshop or something like that, have them fill out a Form W-9. Usually it's something that you want to do every year, but if you know the person well, you work with them a lot, say they're a friend or a family or something, and you know that no information has changed, you really don't need to update it every year. The deadline, I think I kind of hinted at earlier, for filing a Form 1099 is January 31st after a given tax year. But again, late filing is not a big deal, not penalized. As long as you or the contractor claimed all of the income. So this is the last area that I have slides set up for today, and it's honestly and unfortunately the most complex area that small businesses are dealing with today. It's a pretty big pain, unfortunately, and there's a lot of different reasons for that, but it's sales tax. And it's an area that states and municipalities like Denver and Aurora and counties, like I think maybe Jeff County has a sales tax. They're really starting to ramp up enforcement and making sure that businesses are collecting and remitting sales taxes when they need to. One of the reasons it's so complex is that if you can see the map down in the bottom right here, if you can see the details at all, the different colors show different tax rates by county. So even within a given state like Colorado, different counties have different tax rates. So the state of Colorado has its own sales tax rate, but the county of Denver, city and county of Denver has its own sales tax rate. The city of Aurora has its own tax rate. Jefferson County probably has its own sales tax rate. So if you're an artist and you're based in Denver, but you go to an art fair in Jefferson County and sell some art there, in theory, you owe Colorado state sales tax, but you also owe Jefferson County sales tax. And if you don't know what that rate is, or if you're not set up to collect sales tax in Jefferson County, technically you could be in trouble with Jefferson County. So state by state, municipality to municipality, it's different. And each municipality, at least in Colorado for the most part, collects its own sales tax as well as the state. One of probably the biggest issues or biggest fears for a lot of my small business clients with sales tax is that states can go back and audit past years if they find that you haven't done sales tax remittance in past years. And that can get very expensive. In Colorado, can be 8.8% upwards of rate as far as sales tax goes. And they can assess that as far back as they can show that you didn't collect and pay sales tax, and that has to come out of your pocket or your business's pocket. And penalties can be 10% or more. So if you owe $8,000 in back sales tax, they can assess another $800 in penalty on top of that. That's almost $9,000. The other area that I know a lot of artists are, building up on and creates a sales tax complication is e-commerce. If you are based in Denver, but you sell a piece of artwork into Wyoming, you owe no Colorado sales tax on that because your buyer is actually based in Wyoming. However, the Wyoming person might owe use tax, which is on them to pay. But if you sell enough into Wyoming, as far as dollar volume or the volume of actual items, you may actually have to start collecting Wyoming sales tax. But you're based here in Colorado, you don't know anything about Wyoming sales tax. Doesn't matter, unfortunately. So that gets complicated really quick if you're part of an e-commerce platform and you're selling into 10 or 15, 20, 30 different states. If you sell enough, in theory, you could owe sales tax to 15, 20, 30 different states. And if that e-commerce platform is not tracking those sales and collecting and remitting sales tax on your behalf, that's going to be a lot of work and you could be in big trouble with those various states. So one of the other big confusions is what actually sales tax is even owed on. And the easiest rule of thumb is physical items or a digital version of a physical item, like a digital book or an album. Those are things that are commonly sold online now that in a lot of states probably are going to have sales tax that should be charged on them, even though they're digital. But yeah, I think a lot of people know, you go into, an art store or something like that, and you buy a piece of art. that's a physical item, it should have sales tax charged on it in Colorado and also the city and county of Denver. I could not find anything saying that physical art is exempted from sales tax in Colorado, but could be wrong. Most of my artists in Colorado don't sell physical items or digital forms of them. The amount of sales tax charged usually is a percentage of the total sales price. So again, if you're selling a piece of art for $100, city and county of Denver and Colorado state sales tax 8.8%, you need to charge $8.80 on top of the 100. Store back that $8.80, and then either at the end of the month or some point in the future, turn that money into the state and city and county of Denver. Like I said, some states or municipalities might exempt some or all types of artwork, but again, because each area is different, it's really tough to know if that applies in a given area without doing some searching. Another thing that I kind of alluded to earlier is traveling. So, you know, my earlier example is you travel from your, you know, base of operation in Denver over to Jefferson County and do an art fair. You could also do that out of state. And again, and if you have, especially if you have like a somewhat permanent business location, say in the state of Wyoming or something, you actually would, I can tell you, if you have an office or something in Wyoming, you go up to Wyoming, do an art fair and sell some physical items up there, you will owe Wyoming state sales tax. Even if you don't normally sell a lot into Wyoming at that point, as soon as you have an office there, boom, you owe sales tax. One of the biggest probably pains about all this is that for each and every single jurisdiction, as we call them, Colorado, city and county of Denver, Aurora, whatever, you have to have a sales tax license and account set up for each jurisdiction in order to remit or pay in the sales tax that you are collecting. I do sales tax for a lot of my businesses, and it's tedious work. But I have to go into the city and county of Denver and the state of Colorado and tell them, hey, this is how much they sold. Here's how much sales tax should be, or here's how much of those sales should have sales tax charged on it. And then give everything to my business owners and they send in the money. Most business owners find it probably just easier to include sales tax in their business's total revenue. And that's because, to use that same example as earlier, if you've got $100 item that you sell and you charge $8.80 in sales tax, it's easier to just say it was a sale of $108.80 and then back out the sales tax as an expense later on. So that's something I get asked a fair amount about. And then last but not least, you know, kind of last point here is that despite, you know, some digital items and things like that having sales tax charge on them, a lot of digital items also don't. It just kind of does depend, but in a similar manner, the vast majority of states and municipalities and stuff do not charge sales tax on services. So again, if you're working in somebody's workshop and they pay you $1,000 as a contractor, they don't owe sales tax on that $1,000, and neither do you, because you are providing a service. There are some services that are taxed in different states, but you know, kind of the contractor services for something like this would not be subject to sales tax, just income tax, self-employment tax. So that's really kind of a good wrap up on some of the major areas that I get asked a lot about. And so I'll just kind of shut things down as we transition to Q&A here. But here's kind of one of the things I remind clients. General rule of mine is that if you're in doubt about something, it usually pays to ask somebody like me who will just tell you that it depends. Because as I mentioned before and several times throughout the presentation, each and every individual in their business's situation is unique. And while it might depend, by the time we get some facts and details, it is pretty easy to say, you know, okay, here's what you need to do, or in this situation, here's path you need to go down or whatever. But then probably the most frustrating thing I deal with is when some of my business owners, we get to this time of year and they say, oh yeah, I did this. And then I tell them, well, you shouldn't have done that. Here's why. And then they get upset because it's going to cost them tax money, or they could have saved tax money if they had just asked about it ahead of time. So a lot of times it just pays to ask. So with that, transition it back over and we'll get into some Q&A here.
Yay, thank you, James. Oh, hey, lots of computers in this room with me, but you guys just saw. Hold on. No, I'll bring mine up. Thank you so much, James. That's great. I can kick us off with some questions that came through. So appreciate the thoroughness of the presentation. I feel like you hit on so many things that also has been kicked to me before. And yeah, so it's wonderful to have you here tonight. Thank you so much. So the first question we got was a little bit ago from Chelsea. And Chelsea, please feel free to unmute yourself if I say this question wrong. But is there a certain income you should start transitioning to a sole proprietorship with, or to an LLC with? Like, is there a threshold level that should be considered? Is her first question.
Yeah, actually, as far as sole proprietorship versus LLC, no, not really there between those two, because they do get taxed one and the same. So between those two, the limited liability is really the big consideration. However, there is a threshold for LLC to S corporation. And so that's the big one that I probably do the most amount of work with. The kind of usual waterfall would be you start as a sole prop, you transition to an LLC, and then once you grow and you're big enough and you have enough regular income, you switch to an S corporation so that you can get those tax savings. And that one, again, it depends, but for an individual person, probably about $80,000 to $100,000 of profit in your business is when it can start to make sense. But I do have one of my artists is an S corporation. I think his business profits about $20,000 in a given year. So it really just kind of depends. But that financially, that would be my break even there is 80 to 100,000.
And her follow-up was, how is it determined how much a sole proprietorship can write off on their taxes when it relates to materials?
Yeah, that actually, there really is no threshold for that one or determination. If you kind of go back to my kind of earlier example, if you get a grant for $30,000 and you go out and you have to spend $20,000 on the materials, that's perfectly fine. As long as you keep receipts and have records, that's not an issue. I have had only one business client in the last 5 years now get audited by the IRS. He was a small business, but he did start up a business, didn't have a whole lot of income. So that was kind of the first issue here, but he spent a whole lot of money on materials, physical items. He was getting into robotics. And so he bought a lot of metal things and tools, et cetera, and had a big business loss. IRS basically sent a letter that said, hey, we don't think that you actually used all that for business purposes because you had so much more expense than you did income. Prove that that was actually for business. He put everything together, he proved it, and the IRS came back later and said, okay, you know what, you're fine, no problems. So that really, I think, is the best example. Just keep good records, and as long as you're doing it for business, that's fine. Just don't pay for things out of your business that are for personal use and then try and expense them. That's the number one rule. Don't expense personal items.
And then Juanine had a question about for determining your sales tax rate for online sales. Do you just go with the, county and state of residence of the owner, or do you do it from the purchaser's standpoint?
Yeah. So that one, that's part of where sales tax, especially with online sales, gets really tricky. So so here in Colorado, I'm based here in Denver. Let's say that I sell a physical item, but through an online platform to somebody else who's in Denver. My business would need to charge both the state and city and county of Denver sales tax because my business is in Denver and so is my buyer. So it's the equivalent of somebody coming into my store in Denver and buying it and having to pay it here. Now, similar, but say that my buyer is in Jefferson County. At that point, you only have to collect the state of Colorado sales tax. You do not have to collect Jefferson County, and you do not have to collect city and county of Denver. So that's where this type of stuff starts to get complex really quickly. To further complicate it, again, if you sell into Wyoming and you're based here in Denver, you don't actually have to collect and pay any sales tax really, unless you sell a certain volume or dollar level into Wyoming. It's the person in Wyoming's kind of responsibility to pay tax on their end, which never typically happens. But places like Amazon have had to switch to do this. Wayfair is another. I think Etsy maybe is starting to do more and more of this. So more e-commerce platforms are starting to do it. But if you're selling through Facebook Marketplace or something like that, I don't think they're doing it. So that's where these risks kind of come up. So
the next one that came in, can you talk about the process or setup to pay taxes quarterly as a contractor? So I think this gets back to your comment about the sales tax license and account.
yeah. Well, so quarterly tax is actually, the sales tax can be remitted on a quarterly basis, pretty common, or a monthly or whatever. But traditionally, at least, and I'll maybe talk about both here, quarterly taxes for small business owners is actually how most small business owners pay in their tax throughout the year so that they do not have a big tax bill plus penalty and interest when they do file their taxes in April or whenever. It's the equivalent of like somebody working a W-2 job that has taxes withheld from their income throughout the year and that gets sent in on their behalf. Business owners, since they're not employees, usually can't do that. And so they have to send in quarterlies. And unfortunately, usually it takes a tax return before you can really do quarterlies easily. But it is something you actually don't really need to be set up with anyone or anything. There are vouchers that you can download from online from the IRS or from the state of Colorado's Department of Revenue. For the federal, it's called a 1040-ES or estimated tax payment voucher. You fill it out with your personal information, tell them how much you're paying and everything like that and what period it's for. And then you send that tax payment in for however much you want it to be for. And then come tax time, you claim that on your tax return as a tax payment. So it gets treated more or less the same as a tax withholding from a W-2 job. Like I said, you can go ahead and start doing those before you've even filed a small business tax return, just to kind of get ahead of things. But it's tough to know how much you have to pay, and that's where a lot of my business owners struggle. So a lot of times I tell them, if you're below $100,000 in profit for your business, withhold probably 30 to 35% or hold it back and send that in roughly every 3 months. It's not a perfect quarterly system, unfortunately. True quarterlies are every 3 months, but we have April 15th, June 15th, September 15th, and then all the way into January of the next year. Those are the quarterly estimated tax payment due dates, and those apply for the state as well. So that's unfortunately, those are tricky. Whereas if you have tax return that has been filed, I actually give a lot of my small business owners vouchers ahead of time that are pre-printed for $10,000 a quarter. And as long as they pay those, they should be okay come tax time. So that's that process. Now, sales tax, unfortunately, that's a lot more of a process I won't get too much into, but you have to register with each government, get a sales tax license. It takes some time. They set you up with an account, and then from there you can start filing returns. And there are a lot of times can be a grace period when you're starting on that. If you're trying to get up to date and pay your sales taxes, even if you're a couple of months or a year or two behind. If they come to you and say, hey, we're going to penalize you, say, hey, please don't. I didn't know I needed to. I'm trying to do good by you now. And a lot of times they'll forgive those penalties. The first time, if you become a repeat offender, no go.
So, is there a difference in the process of filing when you're an LLC versus a sole proprietor? Is there a difference in the tax rate you pay between these two?
Not at all. No. Both of them file the tax return for the business on a Schedule C as part of the Form 1040. And they will both pay a sole proprietor that has $100,000 of net profit from their business, and a single member LLC that has $100,000 in net profit will pay the exact same amount of self-employment and income tax, all other things considered the same. So yeah, that quite a common one there. The only thing there that saves anybody on anything is the liability protection from the LLC.
Okay, the next one is, how accurate are services like QuickBooks Self-Employed at predicting the estimated quarterly taxes?
Pretty good, actually. I have a couple of clients that use QuickBooks Self-Employed. And then is something I would probably say, you know, outside of my presentation, as you get more and more into business, if you're growing or you have enough income, or if you're just the type of person that is either detailed and wants to keep good track of things, or is not detailed and wants to get some help as far as that goes, QuickBooks is probably the easiest, best way to do business accounting and keep track of records and everything like that. QuickBooks Self-Employed will do a pretty good job of telling you roughly how much, because it will know how much profit you have in a given period. Where it will fall short is if you have other sources of income, you know, whether it's investments or if you have another job or something like that that you work part-time at, it's not going to know those sources of income, which can unfortunately have an effect on the amount of income tax you will owe on your profit from a business, and there it will come up on the short side. But it's better than not doing anything.
Scotty just asked a question. What's the proper way of signing contracts as an owner of an LLC? Maybe you could unmute Scotty and kind of explain a little bit of context for that one. Or do you get what he?
I think I know what Scotty's getting
Okay.
at there. So in that, you know, whether it's you know, signing a contract to do a project or you know, a contractor agreement or anything like that. If you are an LLC, you are going to want to sign as the business. So if I were to sign a contract, I would have the contract filled out for JBL & Co. CPAs. Now, when I actually go to sign, I would sign as, you know, James B. Lee, owner, JBL & Co. CPAs. So if any of you are familiar with like power of attorneys or anything like that, where you have signature power over somebody else, it's similar where you sign for them, but you also have to put your own name down there and basically say, hey, you know, I'm the one in charge here. I have the legal authority here. So.
I'm just gonna throw one in here that I got today. When you are asking for reimbursable expenses, it seems like there's a really fine line between if that's taxed or not, in terms of like, so say for example, someone got a grant for $10,000 and they submitted they basically submitted the receipts to get those submitted because they were using like a fiscal sponsorship or something like that. It is, if they were getting that income based on expenses they did, because it's a fiscal sponsorship model, is it okay for that to be not taxed, that income?
Yeah, well, and so this is where it's reimbursable expenses can, yeah, you're they're very different depending on the nature of them. I should probably say more than anything. So maybe the best way to explain it here is using that example for like materials, and you do get a fiscal sponsorship or a grant. And say it's $5,000 that you spent on materials. You go back to them and say, hey, fiscal sponsorship, give me my $5,000 that I had to spend on materials. In theory, that $5,000 that they do come and pay back to you really is not actually subject to income tax, really, at the end of the day. And that is because you still paid $5,000 for those materials, which is an expense for you. And so on a net basis, which in accounting means basically a net is after expenses, you have $5,000 of income, you have $5,000 of expenses. On a net basis, that's $0 of profit. And because profit is what tax is based on, there is no tax on that.
Would the cleanest way for them to handle that is to, like, in some ways keep track of their expenses and their income on a schedule C? So then if for
Correct.
some reason they do get a 1099 at the end of the year,
Mhm.
it is of that, you can kind of net it out.
That's exactly why I recommend doing that. And so hopefully not get too confusing. What that is called is doing things on a gross level, which is the opposite of net, where gross is more or less everything that you received and everything that you paid for. So yeah, you might get a $20,000 grant and a $5,000 fiscal or reimbursement for your expenses. I would count both of those in total as income. And then all expenses that you paid for any of that stuff in that year also as expenses, versus not including the 5,000. Because what could happen is that, say it's an institution that paid you the grant and gave you the 5,000 of reimbursement, they could send you a 1099 for the total of the two. And if you report less revenue on your business than what the IRS sees you getting from 1099s, they're going to send you a letter that says, hey, you didn't report all of your income, you now owe us tax on it. And it's going to be a lot more work to explain to them, no, I just didn't include all my expenses either. They're not going to, they'll come around, but it's going to take a while and you might have a few sleepless nights. So better to just count things on the gross and
Yeah.
include everything, because at the end of the day, you're not going to owe tax on it. Correct.
Yeah. So Esther's asking, this was my first year filing as a sole proprietor and I was caught off guard by how much I owed. Is there a payment plan way to pay what I owe, or any advice?
Yeah, there is. The IRS does have payment plans that can be set up. States do as well, I believe. The state of Colorado, luckily, we have a pretty low income tax rate here relative to most states. And so not as much of an issue for state, but IRS, yeah, especially because the federal charges that self-employment tax. That's the one that's the biggest sticker shock for everybody, that 15.3%. It's a killer. You can set up a payment plan with the IRS. However, it takes some forms that have to be filled out. The IRS actually wants you to send them bank statements showing that you personally, as well as your business, just do not have the money to pay the taxes right now. So yeah, if you have $20,000 in your business bank account, you owe $5,000 for taxes and you want to stretch it out, they're going to tell you, no, you have 20,000, you need to pay all 5 in tax now, or we're going to start charging you interest and penalty. Unfortunately, that's also a process I cannot be a part of. So I have clients every year, and some right now even still, that are on payment plans with the IRS, and I cannot be a party to those conversations, unfortunately. So
James, the one thing I would love for everybody to know is if you are taking on new clients and how much you want to get called by interested parties, because if you are taking on new clients, I think this group would love to know, because this is such an intimidating process. And also, like, depending upon your average, again, gross, it may be that some structures fit better than others, but yeah, wanted to see if you were, especially leading up to April,
Mhm,
Give
yeah.
you a full tilt.
Yeah, no, it is starting to get to the busy time. So I would say that I every year I do take on new clients pretty much every year. I am trying to grow my business just like most other people out there. The one thing that I would say is that this, even by the we get to this time of year, it is very difficult and I cannot commit a whole lot of time to new clients in small business owners, unfortunately, just because I work probably about 70 hours a week right now at a minimum. And starting in March, that number approaches 80 to 100 every week. And that's just doing tax returns and getting stuff done that I have to get done before April. So that just doesn't leave me a whole lot of time to talk and coach and get new clients going. So if you're an existing business owner and you have things set up, you just don't want to do your taxes anymore, you want to make sure that you're doing everything that you can, and or you just don't want to prepare your returns anymore, feel free to reach out. I would say maybe afterwards I could send you some of my contact information. This time of year, my admin, I have an email address and a phone number where clients could or prospective clients could email or call her. That's the best way this time of year to set up those things. But if you're new or you're just kind of getting set up, I would say post April 18th this year is the deadline. I usually take about a week off after that. Once I start coming back to that, I'm more than happy to have these conversations because it's a welcome break from preparing tax returns. And I find it much more interesting and fun, and I like to help people. So yes, would love to help people, but unfortunately it's another it depends scenario.
Totally. No, that's great. So, I mean, if you do want to drop that admin email in the chat, Lee and I can
Yes.
read it. I just feel like at this moment, we have, 12 folks that you'll be sharing it with, where if you ask us to send it out afterwards, you'll have 135 folks that we'd be sharing it with.
Sure.
Like, this
Sure.
is a less massive lift, but for those of you who get this email, just maybe reach out after April, to give James a little breathing room, because yeah, it is industry standard that not only CPAs are not available through April, but go on vacation the following week.
That's right. Yeah, it's one of those we need a little time to recharge, as most people do when they get busy and get overworked for a little while. But yeah, it really is something. If you can't tell, I really do enjoy it. It's something the vast majority of my artists, I would say, I know, do not enjoy accounting and taxes. And so it really is something that I do have a bit of a soft spot in my heart for artists and creatives, and want to help them out with this process and take it off their shoulders, because there's a lot of things that I don't like to do. And if I can pay somebody to do it a reasonable price, I'm more than happy to do that too. So just know that that's kind of my stance on things, and I'd be happy to help.
Well, we are so enormously grateful, and thank you, Lee, also for, Lee really networked her network to find James. So
Yeah.
thank you so much, Lee. And
Well,
yep, that was Lee. We did record this, so if you guys, we'll share it out with those guys who attended, and yeah, so you can check. So if you weren't able to take copious notes, we have a copious recording, which is good.
of course.
All right, James, we hope you have a wonderful, wonderful, wonderful evening, and thank you.
Of course. Thank you all.
All right, guys, have a lovely night. Go eat dinner.
Bye. Bye, guys.
Hey.